All right, so reducing your taxes, guys. So S corporations get a pretty big advantage when it comes to taxation. Though at first glance, the situation looks comparable to partnership taxation status. If you're a member of an LLC electing partnership taxation, you're required to pay personal income tax on all company profits that are allocated to you. In addition to personal income tax, you're also required to pay an additional 15.3% of self-employment tax, which is simply both the employer's and employee shares of Social Security and Medicare taxes. But with an S corporation, you're allowed to pay yourself a salary, which is a deductible expense for the company, and any amount over that isn't subject to self-employment tax. You simply pay personal income tax on those profits and nothing more after they're allocated to you. This setup differs substantially from LLCs, which have elected partnership taxation, because all profits you derive from the company in that scenario are subject to the 15.3% self-employment tax. In other words, if you're taxed as an S corporation, the amount of Medicare and Social Security you pay is limited to the amount you make or take as a salary, as long as your salary is comparable with others in your position and your industry. Any profits the company takes above that amount aren't subject to extra taxes. In a nutshell, this designation means you save 15.3% in taxes on all profits above an appropriate salary. So if you have a business from which you intend to remove a substantial amount of profits, more than the reasonable salary you're taking, you'll probably see some pretty hefty tax savings by electing S corporation taxation. That's powerful. Whoa, phone almost fell. That's powerful because right now, like as a sole prop, right, so to speak, like if you're a single member LLC, you're paying 15.3% of self-employment taxes, and then you're in addition to personal income tax. Like it's a huge wash, man. Like you want to get into S corp because then the company can deduct the expenses or can deduct the actual salary, right, instead of being taxed at the company level and the employee level. So the sooner the better, man. The sooner the better. But again, it goes back to talking to your CPA and saying, hey, what is the as long as your salary is comparable with others in your position and your industry. So that means that, hey, if you're a manager of a construction company, right, what is the typical salary of a construction manager in a different company? It has to be similar in range. It can't just be like, oh yeah, I'm going to pay myself $20K or I'm going to pay myself $10,000, or you know what I mean? Like you just can't pay yourself a low amount of salary just to elect S corp and then try to get away with it. You'll probably get into some trouble. But if you have a good CPA, they're going to recommend the right thing for you. So cool little tip I wanted to share.